Hello and welcome to the Property Investors Podcast. My name is Tom Webster.
And I'm Rob Holmes.
And you've got the dog behind you, Rob?
I have, but he's making his bed on the sofa at the moment.
And today we had Nick McCullum on the show from Passiv. So Nick is a Canadian software developer and real estate investor that wanted to talk about the platform that they've been working on called Passiv, which lets you sort of manage your investment portfolio on top of, it's like almost like a skin that sits on top of brokerages and stuff. But the conversation was really interesting because obviously we touch on real estate, we touch on sort of how the Canadians view sort of like property and how they invest in it, but also like with the show, we don't want it just to be all property. We want people to be thinking bigger and diversification and thinking about stocks. And I think now is a really good time to talk about it because of all the madness that's going on with Wall Street bets and GameStop and AMC and all those things. But you didn't get involved in the GameStop madness, did you?
I didn't, no, unfortunately. But someone I know, I won't say who, was supposed to call me and about Thursday, Friday. And it was really, really funny because I didn't get a call from them. And then they messaged me and they were like, Rob, I'm really sorry I haven't called, but I'm knees deep in this game stuff, and I'm just glued to my computer, my laptop, dealing with it. And I just went back. I just wrote a message back saying, don't worry, I totally understand. How are you getting on? And he said, well, I bought £10,000 worth of GameStop when it was at $88. As we know, it went over 300, right?
Yeah.
So I said, do you know what? Let's talk next week. You just watch that. Quite funny.
But I think about when this show goes out, so this show goes out next week. So today is Monday the 1st when we're recording this. So it's a little bit more hotter topic now. I've got no idea when this goes out, if it's going to go absolutely bananas or if it's going to be a bit more calmer. But I was just saying to Rob, so I put a little, I did the typical, I actually found out about it about 3 or 4, no, probably like Wednesday I read. And it might be Wednesday, Thursday, who cares? But the stock price was about 120, 140 odd. And I did the typical, oh no, that's it. I've missed the boat. And then it went up and I was like, oh God, I haven't missed the boat. So then I bought some, but I think I bought pretty much at the top. Because then the other day it like went through the roof. Like I like, it was like 40%, well not through the roof, but it gained 40% in a couple of hours. I thought, oh, here we go. I'm going to still make some money. And then it crashed and then I was minus 40%. And now I'm pretty much broke even on it, I think. So hopefully today's going to be a good day. But it's the crypto stuff that I'm interested in because the Dogecoin, like I managed to catch that wave a little bit and cashed out. I was cashing out as the profit was making because I just knew that this was just a complete bubble. Like this is never going to last. But yeah, so let's get back to the show rather than me and Rob rambling on about our crypto and stock stuff. But yeah, so again, like I said, like Nick's a really interesting guy with nice sort of a varied conversation about different aspects. And it was just good to sort of talk to someone from another country and what they're experiencing in regards to investing and real estate and those sort of things. So anything you want to add to that, Rob?
But you might had to unmute myself. No, nothing to add. Let's crack on with the show.
Yeah. So again, if you want to follow us, we're on all the socials at Podcast Property. You can visit the website podcastproperty.co.uk, and please do remember to leave a review on any of the mediums that you're listening to or watching this on because it means the world to us. And I hope you really enjoy the show. And thank you very much for listening. So we are recording, but before we introduce our guest, Rob, what's going on with your fringe?
I literally, I'm looking at the camera going, I have no idea what's going on with my hair this morning.
So for those of you watching on YouTube, you can see it, but for those that aren't, he's gone full sort of like 2005 emo.
Justin Bieber.
You're like an emotional Justin Bieber. Good morning, Nick. How are you, mate?
I'm doing well. How are you, Tom?
Yeah, very well. Thank you very much. So you just mentioned a second ago, so you're from Canada on the East Coast.
Yeah, absolutely. I'm chiming in from a little town called Fredericton, New Brunswick. It's the capital of our province here in New Brunswick and pretty close to where I grew up. So that's home for me.
Oh, fantastic. And you just mentioned it's quite a tough lockdowns, the whole COVID stuff. Has that like made much of an impact on what you're doing?
Yeah, so our government runs on like a 3-color system. So there's like yellow stage, orange stage, and red stage. And red is the most locked down. Yellow is like the least locked down. Like I guess green is technically the least locked down, although we haven't been in green for a year now. But we're in orange right now, so it's pretty strict. Yeah.
So are your restaurants and stuff open? Because that's the one that's killing me.
Yeah, some of them are and some of them aren't. And the ones that are open are like really, limited seating and you have to wear your mask in and everything. So yeah.
You know, it's such an odd time, isn't it? Like, just the whole world is just really weird at the moment because obviously the news only really tells about what's going on in England for lockdown. So you sort of forget that the rest of the world's experiencing pretty much exactly the same as what everyone else is. So yeah, it's quite cool to hear. But rather than rambling on about boring COVID, we've been talking about it for about a year now. so the way we like to start, Nick. So if you'd like to introduce yourself, you can go all the way back to childhood. Sort of give us a big spiel on your career history and what you've been up to, and then we'll just sort of develop the conversation from there, mate.
Yeah, that sounds good. So in terms of like my relationship with, property investing, finance, and all of that, I would say that journey for me really kind of started when I was in college. So my father's a physician, like an emergency room physician, and when I was going to college, he kind of told me like, oh, if you're going to make anything of yourself, you should go and be a doctor. Semi-jokingly, but there's a little bit of encouragement there to go into medicine. So I went in and enrolled in a degree in biology and kind of quickly realized that I don't really like biology at all. And it only took me, a couple months of studying like animal physiology and plant biology to really kind of learn that stuff's pretty boring for me. So I went to my academic advisor and I said, what can I switch into that will still allow me to graduate in 4 years so I don't have to spend any extra time here if I don't have to? So she asked me if I had ever considered switching to a math degree. So that's what I ended up doing, was switching into math. And it turns out that a lot of the good internships and summer jobs for people doing math degrees are in finance and technology. So I went and did an internship at a big mutual fund provider here in Canada, TD Mutual Funds. And that was a really cool opportunity for me because in the same building, you had access to all these different investment management professionals doing all sorts of different investment management strategies. So in one corner, you might have a guy doing, traditional fundamental equity investment management. In another corner of their office, there was someone doing cool stuff with bonds. There was even stuff like synthetics and derivatives. So all the way from like really basic to really exotic, all in one building. And everyone was really willing to talk about what they were doing. And there was a big culture of mentorship. So that was like my first exposure to the markets. It was a really great experience. And I've been hooked on them ever since. After college, I went and got a job doing fundamental equity, like research at a firm in Houston, Texas. So that was a pretty big move for me. It's 5,000 miles away. I think we're actually closer to you guys in Europe, where I'm at right now, than we are to Texas. So that was a big move. Really good experience though. And then after that, I came and kind of got my current gig here at Passiv, where I'm the director of growth. So we make portfolio rebalancing software for DIY investors. And then in terms of property investing, I've always wanted to get into real estate. I've always had a big interest in real estate. So I'm kind of starting to develop my own real estate portfolio now. I have 2 duplexes in my primary residence and looking to add a couple more this year with any luck.
That's awesome. I love the diversity of it all. So because you get a lot of people that might just have all of their investments in property or all of it in stocks and shares or whatever. But the fact that you're doing a little bit of everything, that's really interesting. So if we start with the property stuff, so what was it that sort of twigged you into property? What was the thing that sort of led you into that field?
Yeah, so I had always kind of from a young child, like I can remember being a kid and renting our apartment from like this guy who I grew up in a really small town, about 5,000 people. And when I was a kid, we rented apartments from a guy who was like kind of widely known to be like from one of the richest families in town. So I knew 2 things with this guy. I knew that he owned our house and that he was super rich. So that's kind of like from a young age kind of inspired me that might be a good way to build wealth. And then as I grew up and kind of got older, hopefully a little bit wiser, I started just seeing that trend repeat itself with other people that I knew. A lot of wealthy people had made their wealth in real estate, or maybe not made it. I think a common theme for me was a lot of people that I talked to seem to have made their wealth in entrepreneurship of some kind, and then they deployed that wealth in real estate to grow it for the long term because it's less risky and more kind of predictable. So I had always wanted to get into it, but I was living in Houston, Texas. I didn't really want to build my portfolio there because I knew I eventually wanted to come back to Canada. So when I came back and got this job, I had some money saved up and I was kind of ready to party, I guess.
And then on the sort of the passive side of things, so go into a bit more detail on passive. So what is the actual platform? What does it do? And
yeah, the best way to understand what passive does, I think, is to understand like the problem that we're trying to solve for investors. So I'll take you back like just to a little story from like the early days of passive, because I think that's the best illustration. So the original prototype of passive was built by one of our co-founders, Brendan Wood, and he built it to solve a problem he was having managing his own family's finances. So Brendan was basically trying to manage his own retirement account. He was trying to manage his wife's retirement account. And then he was also trying to manage 2 education savings accounts for his kids. So 4 different portfolios with 4 different like target asset allocations. So he wanted each of those accounts to be invested in slightly different things. And to manage all of this, he kept track of it in like a really complicated, sophisticated spreadsheet. So that spreadsheet did the trick, but it was, really time intensive. He had to do all this manual data entry. And then once the manual data entry was done and it calculated what trades he needed to buy or what trades he needed to make to get invested into his target portfolio, he still had to go back to his brokerage and kind of enter those trades in one by one. So it did the trick, but it was super manual intensive. And Brendan was a software developer, so he kind of knew just like from experience that this was exactly the type of thing that he could automate away. So the original prototype of Passiv was just something that instead of having for him to manually enter all of his holdings for the rebalancing engine to kind of calculate what he needed to buy or sell, it would just read it from his brokerage account by connecting to his brokerage's API. So we've since evolved way past that feature set. The way Passiv works now is you create a Passiv account, you link your Passiv account to your brokerage account, and then you set a target portfolio. Once you set a target portfolio for your account, Passiv does all of the kind of sophisticated calculations to figure out what you need to buy or sell to get invested in your target portfolio. And then once that's done, we allow you to rebalance with one click. So you click rebalance, we send the trades off to your broker, they get executed, and then they send us back trade confirmation. So that's like kind of the 50,000 foot overview of how Passiv works. I'm happy to dive into any details on specifics if you'd like.
That is
my brain is just like computing everything that you've just said. That was a lot. That was really, really cool. Okay, so in terms of setting target portfolios and all of that sort of stuff, just go a bit more into that.
Yeah, so pretty much this idea of a target portfolio was really conceptualized because of talking to other investors and just hearing how people manage their portfolios. Pretty much everyone has some sense of what they want to be invested in, but the harder part is to understand whether or not you're actually in those things without checking your account constantly. So a target portfolio is just like the mix of different investments you want in your account in like an ideal situation. So an example might be some investors want to be like 80% stocks, 20% bonds. Other investors might want to do like a target portfolio of individual stocks. So they might want to be like 50% Apple and 50% Tesla. I can't imagine why anyone will want that exact portfolio, but that's just like a silly example, I guess. So yeah, the target portfolio is basically what you want your portfolio to be invested in. And then as your portfolio on Passiv kind of drifts away from your target, we will send you email notifications so that you can log in and rebalance with one click again.
So just to bring that into some sort of concept for some people is when you're invested in, like, let's say you go and see an independent financial advisor, they are working off of portfolios and percentages. So if let's say your stock part of your portfolio is performing really, really well, then all of a sudden your cash percentage will be a lot less. So at that point, you might decide, actually, I'm going to start selling some of my stocks and shares. And then that's where the rebalance comes in, doesn't it? Say, right, I'm going to put some more money into cash. Then my percentages then all are back where I need them to be, because you don't want to be too overly into each. Like if you look at it as like a pie chart in your head, you don't want one pie to keep growing and then the other ones to get smaller and smaller.
Yeah, exactly. And it gets even trickier when you have like not just comparing cash to different assets, but comparing like different investable assets to each other. Because I would say the majority of the investors on the Passiv platform really don't carry very much cash. One of the reasons they actually use Passiv is so that they get notified when cash hits their account so that they can invest it right away and it doesn't waste any time just sitting there idly. So an example would be like, let's say you have 2 ETFs in your portfolio, one of them, and you want them to be invested 50-50, just to keep it real simple. If one of them goes up and one of them goes down, you'll probably be at 60-40, not 50-50. So what the rebalancing kind of would serve to do is that you'd sell some of the 60 to buy some of the 40 so that you get back from 60-40 to 50-50.
Perfect. And you said ETFs there. Is that what you said?
Yeah.
Can you just explain what that is to the listeners?
Yeah, so an ETF is a type of investment fund that trades on a stock exchange. So it's just an acronym for exchange traded fund, or ETF. And ETF, I would say, for most people, the preferred way to get broad exposure to like a specific asset class. You could buy a large cap stock ETF, or you could buy a real estate ETF, or you could buy a gold ETF. There's ETFs that track pretty much any investable benchmark that you would want. Now, the main advantages of ETFs over their main competitor, which would be mutual funds, there's 3 primary ones. The first is that ETFs are more liquid than mutual funds. So ETFs, since they trade on a stock exchange, you can buy them at any time throughout the trading day. Whereas with mutual funds, they just trade once per day at the end of the day. So ETFs have superior liquidity to mutual funds because of that. The second reason why ETFs are better is just because they have way lower fees. So mutual funds usually charge around 1% of assets under management, and ETFs would charge about a tenth of that. So a lot cheaper. And then the third reason why most people prefer ETFs to mutual funds is they just have way better tax characteristics. So when you're an investor in a mutual fund, you have to pay tax on the performance of that mutual fund every year that you own it. You get these tax forms, you have to file them. It's just more work at tax time and more money that you have to pay. Whereas with ETFs, you actually don't have to sell, or you don't have to pay any capital gains tax on the ETF until you actually sell it at the end of your investment lifetime, I guess. So ETFs allow you to kind of defer the tax that you pay on it indefinitely as long as you don't sell.
That's interesting. And what sort of trends are you seeing at the moment? So where, like, do you get an idea of what people's portfolios are looking like, and are you kind of seeing any trends in the market?
Yeah, so we definitely kind of keep an eye on what people are buying and selling on the Passiv platform, just because it helps us to understand how people are using the product, and it allows us to better build the product for the people who kind of use it the most. Definitely what we see is just like a lot of popularity in the ETF space. So passive investing is kind of more popular than ever. People are realizing more and more that it's hard to beat the market. There are a lot of advantages to just getting broad market exposure, and ETFs are kind of like the main vehicle that people are using to do that. Now, in terms of trends within the ETF space, there's been a huge explosion in like the rise of thematic ETFs. So in the past, you may have only been able to get ETFs with exposure to like really broad and mainstream asset classes, whereas now you can get ETFs that give you exposure to anything. So you can get like an artificial intelligence ETF or a robotics ETF or a genomics ETF, all of these new, novel, kind of exciting trends in the stock market that people are getting excited about. Someone will eventually spin up an ETF for all of them. And that's kind of exciting because investors are able to capture these new economic points of view without having to buy the underlying stocks themselves. So that's cool.
That is cool. It was it was Tony Robbins. He did a like a book and an audio book called I was going to cut his
Money Master of the Game.
No, I think it was more recent than that one. It was Unshakable. It was, and that, you know, out of all the investing books that I've ever sort of listened to, because I'm not much of a reader, that was probably one of the most interesting, because I listened to it thinking it was going to be about the psychology of investing, but it actually went into more detail about what investing is and where to invest. And they talk a lot about ETFs and index funds and indices and things like that. And the reason being is that, again, when we talk about that diversification, is rather than saying I'm going to put all of my eggs in Apple or all of my eggs in Amazon, is you can cross it against 100, 250, as many sort of companies as the fund has got inside it. And then all of a sudden you're looking at these funds that tend to outperform mutual funds anyway. Because for some reason where the mutual funds are trying to bet against the market and trying to guess it all the time, these ETFs and these index funds tend to seem to be outperforming a lot of them over a long period of time. But they tend to be sort of long-term investments, don't they? So I think it's an interesting one where property is definitely a long game, isn't it, Rob? Would you say that?
Oh, 100%. Unless you're doing a short-term flip, so buying something, tarting it up, sticking it back on the market, then yeah, you're buying to build long-term wealth. But I like what you said earlier, Nick, about coming across entrepreneurs that had built a business first, and then once they'd built a business and they'd either sold out of that business or were making cash from that business, they're then putting it into property to hold it. That was interesting.
Yeah, it's just a real safe way to kind of get rich slowly, I guess, over time. But the kicker is you need capital to start, and that's where the entrepreneurship comes into play.
Yeah, wicked. Back on Passiv just for a second. A couple of questions just on what you've said. So obviously it's a platform. One of the questions I've got is where's your money held? So someone that gets a passive account, where is that money? Is this just an app as such that links to a brokerage fund and their money's held elsewhere? Is it held with you?
Yeah, that's a great point. So we actually don't hold the money like you kind of guessed. So kudos to you. We just connect to your brokerage where your money's already at. So we're just a pure play software platform. We don't hold your money. You don't have to transfer your money anywhere to work with us. And just from like our ability to build fast and iterate quickly as a startup, that's actually been really helpful because we can kind of let the brokerages do what they're good at, which is like compliance and all of like the financial regulatory stuff. And we can just focus on building like the best tools possible for investors to actually manage their portfolios. So we think of us as like a software layer on top of your brokerage account.
Okay, cool. And then in terms of brokerages, who do you work with? Who can you connect to?
Yeah, so we're always working on adding new integrations. So by the time this podcast goes live, there might be a couple more to this list. But right now we have in Canada Questrade, and then outside of Canada we have TD Ameritrade, Interactive Brokers, Tradier, Alpaca, Zerodha in India, and we're about to launch Kraken, which is a cryptocurrency exchange as well. So Passiv will be like one of the only places you can go to buy stocks, ETF, bonds, and cryptocurrencies in one place.
Nice. And then for people in the UK, how do they get access to Passiv?
Interactive Brokers would be our main kind of integration there, and we're working on a couple other ones that are kind of like in the conversational stage right now.
Awesome. I want to sort of just talk about like more what do you call it, current affairs. So with all the stuff that's going on with GameStop, Dogecoin, all those.
I knew that's how you get.
Yeah. So are you personally following this? Are you involved in this?
Yeah. I mean, we've as a company, we've been following the whole thing pretty closely. And just for me personally, like I've been in that Wall Street bets community for like ages before the GameStop fiasco kind of exploded.
Oh, amazing! So please tell me that you got in early.
No, I didn't. It's just like it's kind of outside my risk tolerance. I don't know. I feel like I have a pretty good risk appetite, but for me, like I don't know, I'm working at a startup. I'm kind of plowing all my money into real estate and stocks as it is. So
yeah,
my risk budget is kind of maxed out as it is, I would say.
It is fascinating because I must have been Wednesday or Thursday. I sort of saw it starting, and I think GameStop was at about $150 a share. And I did the typical. I think it's gone too far. That's probably it done now. And then it just like,
I've missed the boat. I've missed the boat. Yeah.
So then I did buy in eventually, and I'm pretty much sitting at break even at the moment. I think, but today should be an interesting day. I think like you got talking about like a Ripple. So I've got a bit of XRP in crypto, and that's meant to shoot today based on this stuff. And then it's going to be interesting to see what GameStop does, AMC does. But like just from a more macro level, do you think this movement's going to change how people view investments?
To be honest with you, I think it's probably going to for people who didn't participate in this and don't really understand it, it's going to create a lot of fear and uncertainty around investing. It's probably going to be like a net negative for like the investing society, because people are going to think that the market is like easy to manipulate after this, I think. But that's just my best guess. Who knows what's going to happen? Yeah,
and that is an interesting take on AC, because I think you could look at it 2 different ways. It's either going to engage millions of people into thinking, actually, I can make money through managing my own money, and it is actually easier to invest into stocks and shares than sort of the illusion that it's for the mega wealthy. But that's a really interesting take on the fact that actually it could be a lot of people are going to get their fingers burned because it will plummet at some point. Like some people are going to lose a lot of money doing this. And
yeah, I don't know. I mean, I'm a pretty young guy. I don't have a ton of people like in my age group that like I'm friends with who are like really big into investing yet, because a lot of them are just getting their feet under them career wise. But they all kind of tell me the same thing. Like they read about this GameStop thing and they say, "Oh, Nick, I told you so, man. This whole stock market game, it's just a big gamble. It's all rigged anyway. I can't believe you work in this stuff. It's all a big sham. Like, look at the GameStop thing. I told you I was right." And anyways, obviously there's like lots of factors that go into this, and people see this in the news and they don't realize how unusual it is, I think.
Yeah.
But it's
in the news because it's unusual. It's in the news because it isn't the norm. And it is something pretty spectacular. I don't know how many, but a number of individuals, just normal people that decided to basically take on Wall Street. I heard somewhere, I think it was a Facebook video that I was watching about the whole thing. And don't quote me, but I think the game stoppers, as such as I'll call them, when basically going backwards and forwards against Wall Street, one of them or the group of them turned around and said, "We can stay retarded longer than you can stay liquid."
Yeah, that's because of there's like a language inside Reddit where they call each other like the R word and an A word. And then like
it's a super, super weird little culture in there.
Yeah. But they have pretty much achieved to a certain extent the destabilization that they were aiming to do. I think last time Melvin, have they lost something like 12 billion, or was potentially a 12 billion loss that they're aiming for with this short squeeze? But do you think like the concept of shorting stocks blows my mind anyway? Like, how is that even legal? So if anyone out there that doesn't quite understand how a short works, you're betting against a company. So you're betting that the price is going to go down. And you do that by the brokerage that you work with will synthesize stocks and you sell them to someone immediately, but you don't own that stock. You've just created a stock out of thin air and sold it. Then you wait for the price to go down. Then you buy the stock to give to the company back. So you're creating wealth out of nothing, but you're profiteering off of the destruction or the misery of a business. Like, the whole thing just blows my mind that you can do that.
Yeah, I mean, I don't know. The thing that's crazy to me, so there's kind of like two main ways, like mechanically, to create a short position. You kind of described the first way, which is like a traditional short. And basically what you do is you borrow the shares from someone else, you sell them immediately with the hope that you can buy them back later so that you can return that loan of shares back to the lender. So what that means is you're at the risk that the lender can ask for those shares back at any time. And that's kind of what caused the short squeeze when GameStop started to increase in price. All of these short lenders asked for their GameStop stock back so that they could sell it. And that's why all of these people had to kind of liquidate their positions. And that's what happened to Melvin. But there's another way to short that I'm not sure why people don't use more often. That's just through like put contracts, which is a type of options contract. They're a little more complicated, but they basically allow you to create a short position where the short can't be called back at any time like you can with a traditional short. The only like the trade-off that you have to make with a put contract instead of doing a traditional short is that they have an expiry date on them. So they're an options contract that has like a fixed date at which it will expire and disappear. So pros and cons to both, but I will say a put contract can never put you bankrupt like a traditional short did to Melvin.
Yeah, because it's an unlimited. Do you know, like, if a company goes down and you've bet that it's going to go up, that it will stop when it becomes zero. Do you know what I mean? Like, it can't get any worse. But there's unlimited downside to a short because the stock price can go up indefinitely. So if you're in a short position and all of a sudden you've got all of these kids on Wall Street Bets on Reddit that are just like, right, we're going to get you. Like, it is forever. They could just keep pushing and pushing and pushing. And then I'd suppose people will smell blood in the water. So other hedge funds could go, right, well, I'm going to chuck in on this. I'm going to get in and get out nice and quickly or whatever. But it is an interesting week for shares. And I thought the one thing that I was really worried about actually was the Robinhood sort of scandal, I'll call it, is all of a sudden telling people that they can't buy these shares, but you can sell them. Now that just stinks, because if you can't buy something, then the price won't go up. But if you can only sell, then the price will come down. And there is no way on God's green, and I'm probably going to get done for libel here. So this is my personal opinion, and I'm not saying this as any form of fact. But how is that not market manipulation?
Yeah, so there was actually like mechanical reasons why they did that, to my understanding. So the way that the brokerage space, like the pipes that kind of feed the brokerage space work, it's pretty complex. But there was some sort of like settlement mechanic where after people buy and sell Robinhood, like Robinhood's on the line for that collateral for 2 days until the trade actually settles. And when prices get really volatile, like 2 days ago, people were buying GameStop for $50 and now it's for $300. So from a collateral point of view, I think Robinhood was actually really tight on cash. And I don't really know enough about the mechanics to like explain why, but there was like mechanical reasons why they had to stop like buying and selling of GameStop. They should have been more transparent about why, because on the surface, it kind of just looked like they wanted to stop it just purely because it was volatile. I think some better communications would have prevented a lot of the outrage that you saw from people who wanted to trade on Robinhood. They're going to lose a lot of accounts over that issue, I think, because people lost a lot of money on GameStop who bought it high and then couldn't sell it, or vice versa. So it's going to be interesting to see what happens, but I think they're going to definitely have to do a post-mortem for like the Robinhood's communications team after that, I think.
Yeah, that's going to, if anyone's like works in PR or is going to study PR at university, this is going to be how not to deal with an absolute stock market like scenario. They really haven't done a good job of it. And I watched the video of the CEO going on CNN, I think, and he got pulled to pieces. He really didn't deal with that very well at all. So I was going to say, so if we go back to real estate and stuff, obviously in the UK, there's like different strategies and there's like training courses and there's like this whole sort of ecosystem around real estate, mainly because in the UK, we've got such small amount of land. So we can only build so many houses at such a rate. in Canada, like how does it work in regards to property investing, educating yourself when there is like an infinite amount of land in Canada? Like there's so much space. Surely you just keep building more and more houses and it won't ever be an issue. Well, how does the supply and demand work in Canada for an investor?
Yeah. So for me, like you're right, there's like a lot of land in Canada, but especially where I'm at, it's really divided into like urban and rural. So there's lots of super rural land. If you want to live in the country, that's great. And then there's also like urban land where it's like cities and yeah, so big divide there. For me, like I always wanted to focus on apartments in urban centers, and supply and demand in terms of new construction here is actually a little constrained because people want to be close to downtown. It's just like any other city. So for me, that was kind of like my big philosophy. I think long term, we're definitely not going to see the same levels of price appreciation on individual properties, because if things start to get expensive due to price appreciation, people will just go build more stuff elsewhere that's cheaper, and the prices will kind of like naturally stabilize that way. That's specific to where I'm at in Canada. We have super low population density in my part of Canada, like super low.
And then like with the whole lockdown stuff, so what we're seeing, so London's very much its own economy really, but what's happening is a lot of people are moving out of London into sort of either commuter belt or even further because of the remote working, like Zoom and all those sort of stuff, which will ultimately, that has to have an impact at some point on property prices in London or surrounding. Do you think that, are you seeing a similar trend in Canada?
Yeah, lots of people are moving into like our two big downtown centers, which would be like Toronto and Vancouver, and coming to places like where I'm at, because real estate here is so affordable. Like the last place I bought was a big duplex. It's like 5,000 square feet total. And it was like, it rents for $4,500 a month. And I paid $325,000 for it. So stuff here is just like really, really affordable, and people are leaving the big cities to come to places like this because now all of their like white collar jobs are allowing them to work remotely with no salary reduction. So if you're making $150,000, would you like to spend it in a place where a nice house is $2 million or where a nice house is $300,000? It's kind of an easy choice.
Yeah, no, it's gonna. I was talking to someone this morning actually about how it is going to be interesting to see this culture shift of how we work, how we interact, how all of these things, because we've been forced into dealing like this way. When, let's say, the vaccine comes out, let's say COVID completely disappears and it's done, the after effects of how we all live, that I think that's it. I think that's a proper culture shift now.
Yeah, I think so too. And you see more and more people are investing in a nice home office, buying a nicer house. So I think people are going to kind of put more of their budget towards nice housing in the aftermath of COVID because they spend a lot more time there.
Yeah, no, definitely. You right there, Rob?
We're seeing. Yeah, I'm just chilling out.
Like getting further and further away from the
Chilling
camera.
out,
You're gonna fall
leaning
asleep in
back
the
chair. No, I was going to say that we're seeing that in London, aren't we? A lot of people kind of moving out of London, away from the city because they don't need to be there anymore.
Yeah,
and I think you're right. I think it's kind of a mass mindset change of what is needed, and what people want.
And just cost too. I mean, like what would a townhouse go for in London?
A lot.
Yeah, it depends where.
Depends what part of London.
Yeah, let's say you're just in an average area of London and you're looking at like a 3-bed townhouse, millions.
Yeah, exactly. I mean, that's exactly what I'm in, is the 3-bed townhouse for like my primary residence, and it's Canadian dollars, so it doesn't exactly equivalent like on currency, but I paid $185,000 for this, and that's like was super affordable.
Yeah. So for $185,000, you probably couldn't buy anything in London.
Yeah.
I think the cheapest in London now is well over 200, if not 300 now, isn't it, Rob? I would have thought, even if you're going for a flat.
Again, I'll be honest, it depends where. I'm not too au fait on the London prices because I don't have anything there. But yeah, it's expensive, 100%. Yeah. What would you say happens, Nick, in terms of mortgages and stuff out there, lending for property, whether you're going to get it to live in or you're going to get it to rent it out? Is it quite different over there?
Yeah. So when you buy something as a primary residence, you can buy through like Canadian-backed government mortgages, basically, that allow you to put 5% down. So that's pretty nice for your primary residence. For rental properties,
how much is your interest rate on that?
1.94, I believe.
That's pretty good for only having to put down 5%.
Yeah, strong.
Yeah, the rate actually doesn't change on when you put 5% down. You just have to pay a big like insurance premium at the start that the government kind of takes as insurance to back your mortgage. So I think for I didn't actually do this for my mortgage because the numbers kind of didn't make sense. It was been a lot more expensive long run, and I didn't really need the extra cash that was tied up in my down payment. But I think for my house, $185,000 purchase price, I think the insurance premium was something like $4,000 to do the 5% down. So that's kind of like how that mechanic works. For rental properties at my lender, which is RBC, Royal Bank of Canada, they kind of make you put 20% down on everything. They don't do anything creative on the lending side. So that was fine for my first couple rental properties while I was learning the ropes. 20% down was actually kind of nice because it was like just a little less risky if anything did go wrong. But now that I'm kind of like more experienced, I have 3 properties now. I'm looking to add more. Excuse me. I'm looking to do something a little more creative on the financing side. So whether that's like private lending or going with a smaller lender who will do more, exotic terms or what have you, that's kind of what's probably going to be next for me.
Cool. And what's the interest rates on buy-to-lets like out there?
They're the same as my primary. So I think my 2 properties, just because of buying them at slightly different times, I think one of them is 1.99 and one's 1.89.
That's really nice.
They're cheap. And
Yeah.
it's even cheaper when the value, like the numbers are smaller. So if you're borrowing 100 or 150, but the numbers are still low. Whereas I think like the average mortgage now over here is over 200, isn't it? Rob, you know that?
Yeah, so I have to keep putting myself on mute because my dog is going a bit crazy. I don't want the listeners to just hear a dog barking constantly.
That the podcast that we did with Kenny from Franchise, I had Nala sitting on the chair behind me, and when I listened back to the audio, she was snoring the whole way through. So I've got to apologize to anyone that listened to that podcast.
Yeah, that's go on, Tom.
I was just going to say, no, like, obviously we're taking up a fair amount of your time there, Nick. Is how do people get in touch with you if they want to follow you and kind of get a better idea of your journey and what you're up to?
Yeah, so I'll just say if you want to check out our investing platform, our website's passive.com, passiv.com. There's no E on the end of passive. If you want to follow just like my personal journey as a software developer, entrepreneur, and real estate investor, I have a personal website where I write about a lot of different things on that side, mostly software and real estate. So that website's nickmccallum.com. And if you have any specific questions for me, just send me an email. My email's nick@nickmccallum.com.
Awesome. No, I really appreciate your time there. Thank you, mate. And for us doing our shameless plug, you can follow us on all the socials at Podcast Property. We're on YouTube if you want to watch the video, but obviously we're on Apple and Spotify and all those things. For us, if you can leave us a review, that's like really important. It means a lot to us. So please do that. And yeah, we hope you enjoyed the show and see you next time. Cheers, Nick.
Before you go, I do have one last question.
Oh, shoehorning one in at the end.
Sneaking it in. Nick, so some of the people listening, hold on one sec.
Yeah, I was going to say the dog is going mad in the background. I can see, for anyone that's not watching the YouTube video, Rob's like, get the dog back, get the dog. And he's coming back.
We're back. So Nick, last question for anyone looking to start to get in. Now, I know it's not advice, not financial advice, but any newbies or people interested in this sort of thing, can you just give very briefly some steps and your advice in getting started? Where would you set up an account? How would you then link it to you? What do you cost to do that? And where would you go from there?
Yeah, so I would probably recommend, just because I know your audience is probably pretty global, so I'll recommend Interactive Brokers. They're a big brokerage firm that kind of has, they operate in something like 200 countries. So no matter where you are, Interactive Brokers can kind of fulfill your needs that way. I actually used them for a long, long time, but now I have money spread over a couple different brokerages because I use it to test like our new passive integrations. But Interactive Brokers is really cheap on commissions, really good. Big fan of them. And then to get started with passive, you can just go to our website, passive.com, create an account for free. We have a free version that you can kind of try out, see if you actually like the software first. And then if you decide to use the paid version, which is just offers you a lot more features. And for example, that one-click trade functionality that I mentioned a couple of times, that's only available to paid users. But if you try the software for free and figure out that you like it, our fee is just $99 a year paid with your credit card. So we don't take money out of your brokerage account or anything like that. We wanted our fees to be as simple and as transparent as possible. So that's kind of the fee schedule in a nutshell. I'll also say if anyone's curious about the software, just wants to demo, just send me an email and I'll be happy to kind of hop on a Zoom call with you and show you how it works.
Awesome.
Okay, thank you.
Cool.
Perfect.
Cheers, Nick.
Cheers, guys.
Thank you for listening to the Property Investors Podcast. The information contained in the podcast is not to be used as financial advice. Everybody's situations and goals are different, and you should always complete your own due diligence on investments and seek personalised financial advice from a qualified person. Feel free to contact the show for professional recommendations. Visit propertyinvestorspodcast.com.